Welcome to the Explainer. So today we are unlocking the ultimate secret to a company's true cash-generating power. If you want to know what a business is actually worth, looking way beyond those polished earnings reports and flashy headline numbers, well, you are absolutely in the right place. We're going to master a concept called free cash flow to equity, or FCFE.
To really set the stage here, consider this famous observation by Oscar Wilde. He once described a cynic as someone who knows the price of everything, but the value of nothing. And honestly, that quote perfectly describes a surprising number of investors today. They look at the ticker on their screen, they know exactly what a stock is trading for, but they have absolutely zero idea what the underlying asset is actually worth. In sound investing, you simply do not pay more for an asset than its intrinsic value.
And that right there brings us to the core problem we face as investors. When you look at standard metrics, you might find yourself asking, are companies returning too much or too little to their stockholders? Because if we just look at the dividends a company pays or the net income it reports, we really aren't getting the full picture. We need a far better way to measure the actual raw cash a business has available to hand back to its owners.
To solve this, we're going to methodically break down this complex concept. Here is our roadmap for today's explainer. First, the cash reality check. Second, decoding the FCFE formula. Third, why firms hoard cash. Fourth, growth and reinvestment. Fifth, the illusion of leverage. And finally, valuing the equity.
Part 1. The cash reality check. Moving beyond dividends and net income. Let's completely challenge the illusion that traditional metrics tell the whole story about a company's financial health. Net income is definitely a useful accounting measure, sure, but it includes non-cash expenses and completely ignores essential cash outflows like capital expenditures. And dividends? Well, they're just a discretionary choice made by management. They aren't a measure of what the company is actually capable of paying. To find the truth, we use free cash flow to equity. Think of it kind of like your household budget. It's the actual cash you have left over to put in your pocket after paying your mortgage, your taxes, and fixing that leaky roof. In corporate terms, FCFE is the cash left over for equity investors after meeting all financial obligations and reinvestment needs. It's essentially the ultimate truth serum. It strips away all that accounting noise and shows you exactly how much cash the firm can afford to return to its stockholders right now, without harming its operations.
Section 2. Decoding the FCFE formula. Building the equation step by step.
Okay, let's dive into this and lift the hood to see exactly how this truth serum is formulated. It's actually highly logical. Step 1, we start with the classic accounting bottom line, net income. But step 2, to convert this to a true cash flow, we must subtract reinvestment needs. That means taking capital expenditures, subtracting non-cash depreciation, and factoring in working capital changes. Finally, step 3, we add net debt issued, since new debt brings cash into the business, and repayments take it out. Combine the whole shebang, and you have your free cash flow to equity.
Now, looking at the equity reinvestment rate equation, it tells us how much of the net income is being plowed right back into the firm to sustain it or grow it. You see, before a company can even think about paying you, the stockholder, it has to ensure it has what it needs to maintain its plants, buy new equipment, and fund its day-to-day working capital. Reinvestment isn't just optional if the business actually wants to survive and thrive.
Moving to Section 3, why firms hoard cash. The sticky dividend problem.
So, you might be wondering, if FCFE is the cash available to be paid out, why don't they just pay it all out as dividends? The answer actually lies in boardroom psychology, and this brilliantly illustrates the point. When we look at dividend changes over a 20-year period, notice how incredibly rare dividend cuts are compared to increases or just making no changes at all. Companies absolutely hate cutting dividends. The market punishes them ruthlessly for it. Because of this fear, dividends become incredibly sticky. Even when earnings and free cash flow soar, managers often hesitate to raise the dividend. They're terrified they might have to cut it later if times get tough.
And this reluctance builds into a massive global phenomenon. Looking across different global regions, we see a huge chunk of firms that have positive free cash flow to equity, but the dividends they pay out are significantly less than their FCFE. Across the United States, Europe, emerging markets, and Japan, there is just this massive gap between the potential dividends companies could pay and the actual dividends they do pay. It turns out management teams everywhere love having a safety cushion.
We can actually measure this behavior using a really simple ratio. Total cash returned to stockholders divided by FCFE. If the ratio is less than 1, like those firms we just talked about, the company is paying out less than it can comfortably afford. So what happens behind the scenes? Well, they're piling up excess cash or investing in marketable securities. On the flip side, if the ratio is greater than 1, the firm is actually paying out more than it can afford. To pull that off, they must be drawing down their existing cash balances or issuing new stocks and bonds to fund those aggressive payouts.
Section 4. Growth and Reinvestment. The reality of negative cash flow.
Up to now, we've only really talked about positive FCFE. But what about a high-growth tech startup or maybe a rapidly expanding retail chain? That requires a total perspective shift to negative FCFE. This occurs when a firm's reinvestment needs, its capital expenditures and working capital, are significantly larger than its net income. Now, it's very easy to see negative cash flow and just panic, assuming the business is failing. But negative FCFE isn't inherently bad. Often, it just means a company is reinvesting heavily to fuel massive future growth. They are building the factories and the software today that will generate massive cash flows tomorrow.
That said, there are real implications here. Because the free cash flow is negative, even after debt issues, the firm must issue new equity to cover the shortfall. And issuing new stock means expected dilution in future years, which naturally reduces the value of the equity per share today. But here's the beauty of the FCFE discounted cash flow model. Those negative cash flows in the early years automatically pull down the present value. The dilution effect is brilliantly captured in the model itself. You don't need to make any messy, manual adjustments for future stock issues. It's already baked in.
Section 5. The illusion of leverage. There is no free lunch in finance.
Now, we absolutely must address a very common and frankly dangerous trap. It's the intuitive idea that simply taking on more debt magically improves a firm's value. Acknowledging the math for a second, because our formula subtracts reinvestment and adds net debt issued, increasing the debt ratio absolutely increases your free cash flow to equity. More of your reinvestment needs are funded by borrowing, which leaves more cash left over for equity investors. Wow, looks like you've unlocked a free lunch, right? The released cash can theoretically be paid out as massive dividends or buybacks.
So the crucial point is, here is the catch. When we value an asset, we discount those cash flows using the cost of equity. And the cost of equity relies on a risk measure called beta. When you increase leverage by taking on debt, you instantly increase the firm's beta. That increased beta pushes up your cost of equity. So, in almost all cases, the higher cash flow you generated by borrowing is completely offset by the higher risk penalty applied to your discount rate. Like I said, there are truly no free lunches in finance.
Finally, Section 6, Valuing the Equity, from cash flows to intrinsic value.
We've defined the flows, we understand the behaviors, and we've navigated the traps. So how do we actually use FCFE to figure out what a stock is intrinsically worth? Well, traditionally, investors use the dividend discount model. That values equity by discounting actual expected dividends. The FCFE model is a really powerful variant of this. Instead of actual dividends, it values equity by discounting potential dividends. When we do this, we are making a massive implicit assumption. We assume that all FCFE is paid out to stockholders each period. This means we assume there will be absolutely zero future cash buildup inside the firm.
Bringing the textbook theory into practical reality, we have the formula for the constant growth FCFE model, which is designed for stable firms. P0 is the value of the stock today. We calculate this by taking the expected FCFE next year and dividing it by the cost of equity minus the stable growth rate in FCFE. It's an incredibly elegant tool for sure, but it requires our inputs to be precise. Because we assume the firm pays out all its excess cash, our growth rate estimates must be precisely adjusted.
Which leads us to this really vital adjustment. If the model assumes there is no excess cash left in the firm, then our return on equity cannot include interest income from huge cash piles. We have to construct a non-cash ROE. We take net income and subtract the after-tax income from cash and marketable securities. Then we divide that by the book value of equity minus those exact same cash and marketable securities. This gives us a much truer picture of the return generated strictly by the firm's non-cash operating investments.
We have covered incredible ground today. From stripping away those accounting illusions to understanding exactly why managers hoard cash, and finally using the free cash flow to equity to zero in on a company's true intrinsic value. I want to leave you with a provocative question to consider the very next time you look at a stock ticker. Is the market valuing a company on the cash it actually has or the cash it pretends to have? By mastering FCFE, you never have to guess again. Thank you so much for joining me on this explainer, and hey, keep questioning the numbers.